Restructuring a business is a common event that companies undergo to stay competitive and create additional value for their shareholders. Corporate reorganizations often involve mergers, acquisitions, amalgamations, or other significant restructuring transactions. While these actions can rejuvenate businesses and boost shareholder value, they also often lead to complex tax implications. In Canada, the Income Tax Act, ITA, provides rules and guidelines for different corporate reorganization transactions. Understanding the tax implications is crucial for businesses as they navigate through various restructuring transactions. This article will provide an overview of some common Canadian corporate reorganization transactions and their associated tax implications. Amalgamation is a common corporate reorganization transaction that involves the merging of two or more corporations to form a new corporation. In Canada, amalgamations can be tax deferred under Section 87 of the ITA, meaning that no tax is payable at the time of the amalgamation. Instead, the tax is deferred until the new corporation disposes of the assets acquired from the predecessor corporations. To qualify for this tax deferral, the amalgamation must meet specific criteria outlined in the ITA. A wind-up or liquidation is another corporate reorganization option wherein a corporation is dissolved and its assets are distributed to its shareholders. This can be done voluntarily, through a court order, or by operation of law. When a Canadian corporation is wound up, the tax implications depend on whether or not it meets the criteria for a tax-deferred wind-up under Section 88 of the ITA. Similar to amalgamation, the tax is deferred until the assets are later disposed of by the shareholder if the wind-up qualifies under Section 88. An asset sale is a common type of corporate reorganization that involves the selling or transferring of a corporation's assets to another company. Tax implications in an asset sale arise from the difference between the purchase price and the tax cost of the assets being sold. The selling corporation is subject to tax on any gains or losses realized on the sale of the assets. The corporation may be able to defer the tax on these gains through tax-deferred rollover provisions in the ITA, such as Section 85 for Canadian corporations or Section 85.1 for sales involving non-residents. Share-for-share exchanges can occur in various corporate reorganization transactions such as mergers, acquisitions, and spin-offs. Shareholders in the original corporation exchange their shares for shares in the new or acquiring corporation. A tax-deferred rollover may be possible under Section 85.1(1) of the ITA if the corporations are Canadian-controlled private corporations, meaning that no gains or losses will be recognized by the shareholders until the shares received in the exchange are disposed of. Stock dividends or spin-offs are a type of corporate reorganization that involves the distribution of shares of a corporation to its existing shareholders. Under Section 51 of the ITA, a tax-deferred rollover may be available if certain conditions are met. This means that the value of the stock dividend is not subject to immediate tax, and the tax is again deferred until the shares are eventually disposed of. As this article highlights, tax implications for corporate reorganizations in Canada can be complex and depend on the specific type of transaction and the company's unique circumstances. Partnering with experienced tax advisors and legal professionals is essential to ensure compliance with tax laws and minimize potential tax liabilities. By understanding and complying with the ITA's rules and regulations, businesses can confidently navigate the tax landscape when undergoing corporate reorganization transactions.